US oil prices dropped for a ninth consecutive session on Thursday, falling into a bear market. Crude prices have plunged over the last 5 weeks, buffeted by October's broader market slump. There have been signs of deterioration and in terms of demand and rising output from key producers as well. Let's move right on and bring on board an important voice to talk about this entire space and the global growth which seems to be at risk according to Moody's. We have Marie Diron, Moody's Investor Service. Let's take it across to her. Marie, good morning. Welcome to Market Cafe right here on ET Now. You're making a case in your latest note that global growth is at risk as several key economies withdraw their stimulus program. To what extent of, the impact are you assessing, and what are the other factors do you see which could mainly be concerning to emerging markets at this point of time?
I think there are a number of factors that will contribute to slower growth globally, and including for emerging markets, and that includes a tightening in financing conditions that we have seen already starting in 2018, and we think will continue in the course of next year. That also includes higher oil prices for oil importing economies, as well as an impact of slower trade as the trade tensions between the US and China in particular continue throughout next year. So these factors combined lead us to think that global growth will slow below 3% next year, from around 3.3% in the last couple of years. And for emerging markets, that means that growth in the G20 emerging market economies will slow towards 4.5% next year, from around 5% this year.
Marie, so if you're making a case that the global growth will ease from here on, so does that mean that the crude oil prices, which have fallen about 20% from its recent high, are already pricing in contraction in demand? And if global growth eases, what's the trajectory looking for crude in that light?
As the global growth slow, then oil demand will probably slow as well. We are starting from a position where oil markets are probably relatively tight, and where risk premia geopolitical risk premia are probably affecting oil prices. So we continue to expect oil prices to remain at around the current levels for the next year or two. Over the medium term, our assumption is that oil prices will fluctuate in a range of $50 to $70, and that is really the range at which we expect demand and supply to settle. So near term, there is probably still some pressure for the oil importers in terms of inflation and in terms of current account, but over time we would expect oil prices to move towards that medium-term range.
And do you expect this tightening to be gradual, or do you think it's going to be a faster process? And also, how much will it impact the EM currencies, which were already battered big time in the last 12 months?
Very good question. We do expect the monetary policy tightening to be gradual by the US and then later by the European Central Bank. But the impact of that tightening on emerging markets might not be as gradual. And we have seen already a number of currencies depreciate. We have seen capital flow slow or reverse, and we have seen spreads widen and interest rates rise. So we do expect that for the more vulnerable markets in particular, those with current account and budget deficits, and those where policy credibility is not so well established, that tightening in financial conditions will continue and will be in some cases less gradual than the monetary policy tightening by central banks is.
So have the trade war related issues ebbed in your view? Are there risks of it resurfacing in the near term, Marie?
So As a baseline, as what we think is most likely, we expect that the tensions will continue between the US and China and likely continue to worsen. So we expect that more measures will be taken. For instance, possibly an increase in tariffs. It's been announced already, but that could become effective. Increase in tariffs to 25% from January next year. That is, as I said, the baseline, and that will have an impact on growth, on trade flows, and on growth across the board. The downside risks from that are a further further increase in intentions and a broadening intentions to encompass really relationships in general between the US and China, so trade, but also investment and in general foreign policy. That would be negative for growth globally, for emerging markets in particular, because it would risk slowing or disincentivizing investment across the globe. Corporates would perceive really increased uncertainty about the environment that they will face, and that is likely to be translating into either delays or postponement in investment, and that's really where we expect the economic impact to materialize.
Marie, India has just started to come back from its own domestic liquidity issues just recently, which, it has been facing for the last couple of weeks. How did you analyze that situation? And do you see that it could impact the GDP growth next year as depending on how you look at this as a concern for the Indian markets?
In the case of India, there is indeed a combination of global factors. So the increase in oil prices is relevant, and we've seen the rupee depreciate from earlier in the year already, and more recently, more domestic factors with the tightening of liquidity in the wake of pressure on the non-bank financial sector. We expect that tightening liquidity and tightening availability of credit will continue as the non-bank financial sector in particular remains under some pressure, and that will have an impact on the economy. We have revised our forecast, our GDP growth forecast, down slightly to 7.3% for next year in 2020 as a result.
We are talking at a time when India is passing by the anniversary of the demonetization move done by the government in order to crack down on the black money and trigger formalization of the economy. How, in your view, is the Indian economy coming back from it, and was it a hit or a miss in your view?
The economy seems to have adjusted to demonetization. We knew from the start that it will be a somewhat protracted process, and it has taken a few months. But the money growth has come back in, and companies, individuals have adjusted to the new system. As to whether demonetization in its objective of addressing the shadow economy, of reducing the shadow economy, whether that will be successful, I think that has yet to be seen. That will be really revealed over a number of years. It is also that demonetization took place, was implemented in conjunction with other measures by the Indian government to try to address that issue and removing really cash transactions across a broad range of goods and services to that purpose, and targeting benefits more directly. So all of that is the benefits of that are yet to be seen, and that is something that we will observe over time. From our sovereign credit analysis perspective, that is something that if it does achieve its intended purpose, we would see in terms of higher revenue collection, and so some benefits in terms of deficit reduction for the Indian government.
All right, Marie, thank you so much for taking time out to chat with us about the various issues plaguing the emerging markets in India specifically.